Okay, let's get started. Hi, I'm Debbie Schwartz, founder of Verge College. Thank you all for coming tonight. We are going to talk about student loans and how you can find the best interest rates out there. Let me just highlight myself and our special guest. Okay, Chris Abkarians tonight. So I am from Road to College. I think a lot of you guys know me. And Chris started a company called Juno, which we're going to learn more about tonight. But Chris and I, in general, are going to talk to you about student loans, the federal student loans, the private student loans, because it's important to understand the federal student loans before you go to the private student loans, and then how you should be shopping for loans and how you can get the best interest rate. So before we get started, always love to know if you can put in chat where you guys are watching from. I assume most people here have a student that's going to be a freshman this fall. Tell us, have you started looking for loans yet? And if you have, what type of rates are you seeing? Because I'm already seeing the discussion, and I told Chris earlier, I'm seeing the discussion that people are having online in Face group about rates that they have already gotten, and a little bit shocking, and I don't blame you guys for some of the rates that you're seeing. So let us know if you've been doing any rate shopping and what you might have gotten already. Okay, and if you come in unmuted, and I don't know why people still are, if you don't mind muting yourself, that would be really helpful. And I'm trying to look for allow. Nope. Okay, so let's see what people have said. Wow. Oh, Melissa, you just got a rate for 4.6%. Do you mind sharing where you got it? Because that's honestly a pretty good rate. Yeah, it's very good, right? So it caught my eye. So if you're willing to share, we'd love to know. If you have, I see some people haven't started looking for loans yet. That's okay. Glad that's why you're here tonight. But honestly, as soon as you get off tonight, you should start, and we'll tell you why. Let's see. Started looking for loans now, but I don't know where to be. Oh, you want to start to look now, but people don't know where to begin. So we're going to talk about that. That was from Edvest in You. I've been seeing that they've been giving good rates. Chris, have you heard the same thing?
Yeah, no, absolutely. We see a lot of the quotes that come in. Best in You is definitely one of the better ones.
Okay, well, thank you for sharing that. Oops, let me wait. Somebody just said Sally Mae 8.9 plus. Okay, we'll tell you how you can probably better that. Yeah. What was that?
Well, then I see another Sally 4.0. These aren't completely comparable apples to apples because they're going to be mixing a lot of different terms. So we're going to go through all of that for the next hour. And hopefully at the end of it, we'll be able to all make better decisions about how to compare that 8.9 to that 4.0 to anything else you might get quoted. So looking forward to tonight, and thanks for joining us.
Yeah. Okay. So I'm going to switch over and share some slides. Feel free to keep putting questions in the chat. And this is recorded. So tomorrow we will send out a link to the recording. But as Chris said, this will probably be 45 to 50 minutes, and then we will try and answer as many questions as you have. Okay, so let's share. Okay, great. Can you see that? Okay. And one last thing, let me just open my chat. Okay, so as I mentioned, we're going to talk about the direct federal loans, which are both the student loans and the parent loans. We'll talk about private loans. We'll talk about the timing for this whole process, and then how we can help you get the lowest student rates out there. Student loan rate out there. As I mentioned, I'm Debbie Schwartz. I'm here tonight with Chris Abkarians. He founded a company called Juno, which he will explain in detail about, and it's part of what's going to help you find the best student loan rates out there. As we all know, paying for college has unfortunately become one of the biggest financial decisions families are making these days. And as with tonight, we really want to give you the landscape of all the different loans that are out there and how you should navigate between federal loans and then private loans, and then within private loans, how you look at all of the different features and terms related, so that you understand the offers that lenders are providing you. Okay, so we're going to start with the federal direct loans. And the reason why we explain the federal loans, and we'll probably repeat this many times over, is if your student needs to borrow any money, they should always be borrowing the federal direct loans first, and they should max out whatever is offered. And we'll show you what the amounts are per year in a little bit. But these federal loans for students are probably initially as a freshman and sophomore, probably the only loans that they will be able to get that are strictly in their names. So the direct federal loans for undergraduates do not require a cosigner. So this is a loan that is only in your student's name. Your student is the sole responsible person, borrower for it. And as a parent, you do not have to cosign for it. In addition, these are usually the lowest rates out there for these types of loans, and we'll show you what those rates are. So I mentioned that there are limits for freshman year, and I assume a lot of people now who have already started the loan process, and probably as part of the financial aid awards that you received, you saw that the maximum a freshman can borrow is $5,500. It goes up a little bit. Sophomore year, $6,500, and junior and senior year, $7,500. And what's important to know about these maximums is that you can't, if your student decides not to take out a loan in freshman year, and then they might need more money in sophomore or junior year, you cannot go back to the year that you didn't take the loan. So it's only available this year. And for that reason, we really highly encourage that families look at their 4-year plan, because you don't want to be in the situation where in junior year, you realize, oh, I should have taken out the freshman year loan, but we didn't. And now we're going to have to take out loans probably in the private lenders, because we need more than the $7,500 that is a maximum that junior can take out. So it's really important to understand how much money you'll need to borrow for each year over 4 years. And, if there's any borrowing to be done, everybody in the industry would tell you to always max out the federal student loans and these maximum yearly limits. So the rate, which was recently set, covers any money that is borrowed between July 1st of 2022 up to June 30th of 2023. And it's a fixed rate. It is the same rate. So it is 4.99%. And there is a small origination fee of 1.057%. Each year, a student takes out the federal loans, there will be a different interest rate. So next year, we don't know what that interest rate will be, but it will be slightly different, but it will be a fixed rate. So if a student takes out loans for all 4 years, they will end up with 4 separate loans from the federal government at all different interest rates. The other thing I want to mention is the maximum dollar amounts here that are listed is for a combination of subsidized and unsubsidized loans. So some of your students in their financial aid awards might have been awarded subsidized loans in addition to unsubsidized loans. And together that maximum is, together that sum is what you see here in the chart. And what the subsidized loans mean is that while your student is in school, the government is really covering the interest rate. And so your student isn't charged any interest rate. But once they graduate after a 6-month grace period, they will be charged the interest rate that people with unsubsidized loans are charged. Anything else, Chris, I missed in this part of federal loans before we go on?
Yeah, maybe I'll just add 2 points and back up for one moment, just for a little bit of setup for the next 20-30 minutes. But what we're walking through is really a decision tree here. We're going to try to break down what your different student loan options look like and the different programs that are available to you from the federal government. And then we're going to be going through a set of decisions to say, okay, for the first, let's say $5,500 that I want to borrow, what should I be comparing? And I think the answer to that from everything that Debbie just walked through is that this program, if what you need to borrow is up to this $5,500 limit, is what you want to use. There's a lot of reasons why. Two more that I just want to touch on really quickly are one, there are material protections built into the federal direct loan program in case your student is unable to make full payments after they graduate. And that also includes the ability to have these loans forgiven if they're going into some form of public service, working at a nonprofit, or even if they're becoming doctors or dentists in many cases. And so it's really a program that has a lot of protections built in that other products don't have. And lastly, just on that same point, I have no crystal ball, so I don't know if anything is going to happen. But if theoretically there was some form of blanket student loan forgiveness, this would be the program most likely to be impacted by that. And so there's just a lot of reasons why, to Debbie's point earlier, like pretty much everybody in the financial student loan world would tell you that this is the #1 place to start.
So there's a question about how do you apply for the federal loans, and an important step, which I didn't mention, is that to get access to any federal loans, families need to fill out the FAFSA. So that's a question that comes up a lot. Like, why do I need to fill out the FAFSA? I'm not going to get any need-based aid. And that could be true for many, many families, that you won't receive need-based aid. But the real purpose of filling out the FAFSA is that you will get access to your student will get access to the federal student loans. And if you choose to, you will get access to the Parent Plus loan, which we'll talk about in a minute. And because you need to fill out the FAFSA to get access to these loans, if your student is borrowing any of the federal loans, your family will need to fill out FAFSA every year that your student is in college. So it is not a one-time form. It is actually for each academic year that your student needs to borrow money, you'll be filling out the FAFSA. So somebody's asking, where does the extra $4,000 come into to get to the lifetime max?
So that's in cases where somebody takes longer than 4 years in order to get their degree, and could cover things like summer school.
Correct. Okay. So in case for some people who didn't understand, I mentioned that for the federal loans, there was, what was it exactly? 1.057% origination fee. I'll just quickly explain what the origination fee means. It's not as impactful on the federal direct loans, but it is a material fee when we look at Parent Plus loans. And basically, an origination fee is some form of a disbursement fee. And so it's a fee to cover the processing of the loan. And so what it means for, like the example we give here, is if you are borrowing $1,000, you will pay interest over the $1,000, but you will only net, in this case, $989 because they've taken that fee for processing. So it's just something to keep in mind. Again, I'm going to show you in the Parent Plus loan, the origination fee is larger, and sometimes people are running the numbers and they're very tight. They're trying to get down to the dollar, and they assume if they borrowed $10,000 that they're getting the full $10,000, and they actually get slightly less that is distributed to the dispersed to the college. So it's the fee that makes up the difference. So the Parent Plus loan is the other federal loan that is available if your family fills out the FAFSA. As Chris mentioned, we're kind of, to some extent, trying to walk through a decision tree about where you should borrow money. And the first source is actually, in my mind, not really a decision. It's just a default. Everybody, if you're borrowing, needs to borrow from the federal student loans first. And now we're at, like, the next decision tree is, should I be, if I need more money than what the federal student loan offers, because I might max out and I need more beyond, in this case, the 5,500 for freshman year, do I then go look at borrowing from a Parent Plus loan, or do I go look from borrowing from a private student lender? So let's talk through those two types of loans, and then we'll talk about the pros and cons. So Parent Plus loans are available to any parent who has an undergraduate student who's enrolled at least half-time at a college. And the big difference about a Parent Plus loan is that this loan is solely in the name of the parent. Just like we talked about, the federal direct loan is in the name of the student, and the parent has no responsibility. It's actually the opposite here. A Parent Plus loan, it is solely in the name of the parent, and the student has no responsibility. And I only emphasize that is because, unfortunately, sometimes I have emails from families where they said, well, we made this agreement that I would take the Parent Plus loan, and then when my student graduates, they'll help pay it back, but they're not. So, that is a good, way to approach it. But honestly, legally, if your student chooses not to pay back or help you pay back the loan once they graduate, they have no legal and financial responsibility. It is in the parent's name. So that's just something to keep in mind. And that's actually going to be a big decision between one decision about why some people go with a Parent Plus loan versus go with a private student loan. The other thing is that the Parent Plus loan is also a fixed rate. It's higher. As you can see, the current rate now is 7.54%. It was just set a few weeks ago. Again, that changes every year. And the Parent Plus loan has an origination fee, which is pretty significant. The origination fee is 4.228%. So that means every year you as a parent choose to use a Parent Plus loan, you will have to pay this origination fee. This is this year's origination fee. It usually stays somewhat similar, but it just as the rate can change, the origination fee can also change. So that's a significant number. And if we were to estimate if you added in the cost of a 4.228 origination fee to a rate of 7.54%, you're probably looking at a total interest rate of over 8%. And so when you start comparing the Parent Plus loan to private student loans, you really want to look at that combined interest rate of probably around 8% to what you might find in the private market. And just as I mentioned, or somebody asked, how did you apply, or how do you get the federal direct student loans? The same thing for the Parent Plus loan. Your family has to have submitted the FAFSA. Most parents are eligible to get the Parent Plus loan. It is not based on credit score. There is a really light credit, like review of your credit, and it's there are a small number of parents that might get denied, and that's really if you've had a bankruptcy or some liens against your credit. But majority of the parents are approved. And if by chance you are denied, your student is allowed to borrow a little bit extra in the federal direct student loans. Chris, anything I missed before going on? And I'll look at the questions as well.
I'll just try to answer a few of them. So I wanted to ask a question about whether a Parent Plus loan can qualify for public service loan forgiveness if her daughter is going into a profession that would qualify for public service loan forgiveness. And that's just those two things are actually separate. So Parent Plus loans can qualify for public service loan forgiveness in some cases. It's a little complicated, but the borrower, meaning you, the parent, would actually have to be working in a qualifying job that will actually meet the standards for public service through the Department of Education. So I just want to make sure that that fact is clear. And Debbie, as I was writing that up, I just want to make sure I didn't mishear this. Did you mention the part about deferring payments until 6 months after?
I mentioned it for the undergraduate loans.
So one thing about Parent Plus loans that is really helpful to know is if you do end up using this, you are able to avoid making any payments until 6 months after the student graduates, but you actually have to make a request to do so. The standard scenario is that you're supposed to start making payments 60 days after disbursement, meaning when the money is sent to the school. But that can get extended all the way to 6 months later, as long as you request it. So if you end up using Parent Plus and you want the option to defer, just ask your financial aid office about it and they'll help make sure that you're able to do so.
But you are still being charged interest.
You are still, yes. So you would still be charged interest from the moment the money is sent to the school, no matter how you're deciding to pay it back. But a lot of people just want the optionality to avoid making payments until later.
So Edita is asking if what her student was offered in subsidized versus unsubsidized. She's saying, I guess if your student was offered a $500 subsidized loan, I would take it, even, if I would take any amount that was offered as subsidized this year, and maybe next year you would be offered a different amount. But even for 500, it's not a lot of paperwork. I would, take the subsidized loan. Let's see. Kenya's asking, can each parent separately apply for a Parent Plus loan if they're individual names, or is it based on total household income, married situation?
So you're happy to.
Yep, go ahead.
So the Parent Plus loan, let's say you start off with the amount that you'll qualify for is the same, whether it's one parent actually applying or another, as long as you qualify. The borrowing limit and the interest rate are going to be the same for everyone at each school. The borrowing limit is set by each school. So it's cost of attendance, which is tuition plus fees plus some estimate the school does for what room and board and personal expenses should cost for the academic year. And as long as one of you qualifies, then yes, only one person actually has to take that out. And you can use, let's say if you had 2 children or 3 children at school at the same time, you can actually use a Parent Plus loan for each one of them.
So let's see, there's a question. Whoa, they're piling up quickly. What if the Parent Plus loan, a parent is working for the government, would they be able to participate in the forgiveness program? I don't think it matters where you work.
So the Department of Education has a tool to let you look up whether your employer is a qualifying employer for public service loan forgiveness. And so, and to the best of my knowledge, government employees almost always would be qualifying employees.
Good question here. Can you split the Parent Plus loan in half if divorced as 2 separate loans? I can't say I know that for sure. I'm actually leaning towards saying yes, but we can follow up on that. Definitely I've seen it where one parent takes out the Parent Plus 1 year and then the following year the other parent takes it out. Okay, so let's move on and we'll keep looking at questions. So here's a really quick summary of the federal direct student loans that we talked about earlier. The origination fee right now is 1.05%. 1.057%. Interest rate is just under 5% at 4.99. The maximum for the freshman this year is going to be $5,500. The rate is a fixed rate. And when I say fixed, it's fixed for the whole life of the loan at the 4.99%. This is a loan that's purely in your student's name. Again, we highly encourage if you have any borrowing that you need to do, that students max out this loan. They both max out whether it's a subsidized or an unsubsidized loan. They should take these loans first, and then if you need to borrow more, make a decision about whether you're going to go Parent Plus loan or private student loan, which we have to still talk to you about the private loans. The Parent Plus loan origination fee is higher. It is 4.228%. The interest rate right now is 7.54%. The amount you can borrow, as Chris started to explain, is really up to the cost of attendance, but it's determined by whatever the school's cost of attendance is minus whatever aid that you might be receiving from the school. So it's your net cost. That's how much you'll be able to borrow. And the rate is a fixed rate. And this loan is only in the parent's name. So as Chris was mentioning, this is kind of like a decision tree. So the first question is, does your student need to borrow more than $5,500 for this year, or whatever the maximum might be in whatever year they are in college? If the answer is no, then it's pretty simple. All they need to do is borrow the federal direct loans and you're done. But if you need to borrow more than the $5,500, your next question really is, who do you want to have responsibility for that borrowing? And there's two choices. It can be where the parent is the sole person responsible. And in that case, you might be leaning more towards a Parent Plus loan. Or if you want to share the responsibility of repaying that loan between the parent and the student, that is a reason, plus other reasons, in particular that you could get a better rate, that you would want to consider a private student loan. So as we're talking about private student loans, there's really two types of private student loans, but I will tell you that the majority of people are really getting the private student loan as opposed to the private parent loan, but we'll explain both. But most people are looking and researching and ultimately borrowing through the private student loan. So a private student loan is made in the name of the student, but it usually requires a cosigner. As we all know, our students are 17, 18, maybe 19 in that freshman year, and they just don't have the credit history, the credit worthiness that a lender feels comfortable to just lend this amount of money to just the student. So they are asking for cosigners to help guarantee that the money will be paid back. And a cosigner is most likely a parent, but actually it doesn't have to be a parent. It could be any other adult. Sometimes grandparents are cosigners. Sometimes aunts and uncles are cosigners. You want to pick a cosigner who has a good credit score, because that good credit score will help the student get a better interest rate on the loan overall. And most private student loans don't have that origination fee that we just described, that the federal loans have, and particularly the Parent Plus loan. So in addition to a private student loan, there is a loan called a private parent loan. And those loans are, not all lenders offer these loans. And these loans are in just the parent's name. And it's really the people who end up taking a Parent Plus loan are parents who want to have the full responsibility of paying back the loan. They don't want, for whatever reason, their student to be on the loan. And they also usually have better credit score, and they feel that they can get a better interest rate than what the government is offering in the Parent Plus loan. So it's a small minority of families that use that loan. Majority of families, if they're going to go into private loans, are using the private student loan, where the loan is in the name of the student and the parent is the cosigner on the loan. Chris, anything you want to add before I go on?
No, that was great.
Okay.
Yeah.
So there's something in the student loan space called pre-qualification. And kind of like if you were buying a mortgage, you would get pre-approved. This is similar, not exactly the same, but pre-qualification allows you to go to a lender, or there are some marketplaces like a company called Credible, and you can provide them with some information. And what they will do is they will provide you back a more narrow range of what your interest rate might be if you were to apply to that lender. So it's kind of giving like a sneak peek of what type of an interest rate you might get from the lender. The reason why some people want to do this pre-qualification is they want to kind of get an idea of what type of interest rate they might get from the lenders. Whatever rate you get in pre-qualification is not a guarantee, but again, it just kind of narrows and gets you closer to what the lender might offer if you would actually fill out a full application. And the reason why it's not an exact number is because the lender is doing what they call a soft credit pull. So they're getting some of your information. They're not getting all of your information from the credit bureaus. So the good part of that is you can go to every lender that offers a pre-qualification and ask for it, and you will have no impact on your credit score. So again, we really encourage people, not that you're late, but we've been talking about loans now for probably 6 weeks. And at the beginning of June, we really highly encouraged families to do a lot of pre-qualification work because they were doing research and they were kind of shopping the market out there. And so this gave them a better idea of which lenders they would potentially get the most favorable rates from. And then they could narrow down who they wanted to ultimately apply to. But you can still do it today, even though your window of probably when you need the money is a little shorter than it was at the beginning of June.
On that window, I'd maybe just add really quick, you're very likely not even close to too late to start. But as Debbie's accurately mentioning, the window of time between now and when a school actually needs the money, called the due date, is certainly shrinking. And it can take as little as 5 days, we've seen, for the process to be completed end to end, and as long as 4 weeks. And it can get more complicated depending on your income and employment and whether that's more complicated. So just going to keep that in mind. Find out what your student's due date is and work backwards from that at least a month, and make sure that you're doing the pre-qualification work that Debbie's describing.
So somebody's asking, where do you go to pre-qualify? So most lenders these days are offering a pre-qualification. So I would encourage that you go directly to the lender sites. It used to be a few years ago, not all the lenders were doing pre-qualification, but a lot more are these days. So I would first go to the lender site. And then there is a marketplace called Credible, which doesn't work with all lenders, but they work with a nice subset of the lenders. And if you go there and you put in your information, you will be able to get a pre-qualified rate back from whatever lenders are on their site. Okay.
Do you mind if I take a minute just to walk through maybe so we're going to go through this again in a few minutes, but I see a few questions here on how do you know who offers the best rates, where should we be pre-qualifying, and so on. And really, there's a couple of places we can check that are going to cover the vast majority of options that you'll have. So as Debbie mentioned, Credible is a great place to start. They don't have all lenders on them though, and so some of the better rates might be elsewhere. But if you start there and check, you can get quotes from a wide variety of lenders really quickly. After that, I would make sure to check your local credit union, as well as some larger national credit unions. And there's actually a lot of tools out there that will help you do that pretty quickly. Some of the credit unions have been offering by far the lowest rates that we've seen consistently. And so just make sure to not forget that they're there. And then the major lenders who aren't on that Credible platform are, at least very easily, are Sallie Mae, SoFi, and Earnest. And so we'll go through this again a little bit. I'll explain a bit more of the process and kind of how we fit in. And I think we'll send you lists of these names.
Yeah, I was just going to,
easier.
Yes, I was just going to say that we're throwing out names of lenders. Maybe you recognize some of these names, but I also wouldn't worry too much because we have some follow-up emails that we're sending out that honestly summarize what we're talking about tonight, actually give you the steps that you should take to start researching loans, and also give you links to these lenders. So the names that we're throwing out, if you catch them, great. If not, there'll be an email with all this information in it. Okay, so what I have here on this slide are the different features or options that will be offered to you when you apply for a private student loan. And I'm going to describe each of these options, and it's the combination of these options that you ultimately get to choose is what impacts your interest rate that a lender offers you, and I'll explain why. So the first is the interest rate itself. You have the option of choosing a fixed rate or a variable rate. A variable rate will change over time. It's pegged to a certain index. The fixed rate is exactly what it says. Whatever they tell you at the beginning of the loan, what that rate is, it will be that rate for the entire length of the loan, even if interest rates change and go up or down. Whatever rate you started your loan at will be the rate for the entire length of the loan. So that's one choice. It's hard to say. It's hard to really give advice about whether you'd like to go with fixed versus variable. I will say that the majority of people do go with the fixed rate, except some people choose variable rates in a situation where they may have they know that they just need this loan for a very short period of time. Sometimes they just might need to cover, 2 or 3 years, and they are going to be able to pay it back. And in that case, they're willing to take the risk of the interest rate changing because they know that they're not going to have the loan for a 10+ year term. So that's usually when people are willing to take variable rates. Most people feel comfortable with a fixed rate and not kind of going with the ups and downs of what might happen with changes in interest rates, like what the environment is that we're in today, which we'll talk a little bit about that. The second really important feature to understand is a cosigner release. So we talked about, that one of the major differences in going with a private student loan is that the loan is in the name of the student, but it's only in the name of the student because there's a cosigner, that's willing to help that student take out the loan and get a better rate. Well, most times that cosigner ultimately wants to be released from that loan, and each lender has slightly different requirements for when they will be willing to release that loan. And I can't stress how important it is to understand what those requirements are up now. And they, right now, as you're taking out the loan or as you're comparing lenders, and they do vary. One lender might want a graduate to have a certain income level or a certain, debt to income level. And most lenders, I will probably say all lenders will want to have a student to have, usually it could be between 24 or 36 months of positive payment history. And what that means is that there can be no missed payments during a 2 or 3 year period. That's really important that almost every lender looks for. So if for whatever reason, it is not clear on the lender's site what the cosigner release is, ask. Absolutely, I would never make a decision about choosing a loan if you are the cosigner without knowing what these requirements are. And again, if they don't make it clear, they know the information, and you should ask them to spell out what those requirements are. The next option is actually, you can choose different repayment options. So and these are usually the 4 different ways that you can choose to start to repay the loan. The first is that you might decide, as Chris described earlier, that you want to defer all payments while your student is in college. So that means you wouldn't be paying anything until the student graduates. Most lenders also give you a little grace period, but during that time, your interest is still accruing. So you may not have to pay, but the interest is still being calculated, and it will be added to the loan when your student graduates. The second option is that you might choose to just pay only the interest while your student is in college. Or you might pay a small portion of the interest because maybe you can't or you don't want to spend the money to pay all the interest. And another option is that some people just say, I'm not sure how much I can afford. I don't know if I'll be able to afford the whole interest, but I know I can afford $25 a month or $50 a month. And they just come up with a fixed dollar amount and they say, that's how much I'm going to pay, while my student is in college. I would encourage everybody, if you can pay something while your student is in college, it's worthwhile. Again, you might not be able to pay the full payment, but if you can come up with some fixed dollar amount, it would be important towards starting the repayment process and ultimately reducing how long it's going to take to pay back that loan. And the last option is the term. How long are you going to take to pay back that loan? And different lenders offer different, what they call term options. So some lenders are very flexible. They actually offer all of these. You can pick and say, I'm going to pay the loan back in 5 years, or no, maybe I'm going to take 8 years, or no, I'm going to take 12 years. There aren't that many actually lenders that go to 15, but I think might be one out there. And so this, on most of the lender sites, when you choose these different options, it will also tell you how much the loan is going to cost in total, because the longer it takes for you to pay back the loan, honestly, the more that loan costs you, because you're borrowing for a longer period of time. So you were paying interest for a longer period of time. But the flip side is the shorter amount of time that you decide to pay the loan back, you will pay less in interest. So the total cost of the loan will cost you less, but your monthly payments will probably be higher. So these are the trade-offs. It's kind of like you're fine-tuning what you can afford. And you put all of these things together, whether it's a fixed rate or a variable rate, what type of repayment option you're going to choose, and how long you're going to take to pay back the loan. And all of these factors go into the interest rate that the lender is going to offer you. And the simple way that I try and explain it to people is the faster you will pay back a loan, then usually, and the faster you pay back a loan and the sooner you start repaying, you will, the lender views you as less risky, right? The quicker you're going to pay their money back, the less risk they have. And the less risk they have, the better the interest rate is that they will offer you. So I could have, and I will make it up, let's say I have a credit score of 750. Depending on how I choose these options, I will get different interest rates from the same lender. So I'm the same 750 credit score person, but they will offer me a different interest rate because if I decide to take longer to pay back the loan, I become more risky to them. So all of these factors go into the interest rates that they're willing to offer you. I hope this makes sense to people. Chris, anything you want to add, or I know you're answering questions?
Yeah, just been trying to answer a few questions here and there. There's one actually a really good one from Paul, is the interest simple or compound. And so generally when we're talking about a loan product, the majority of people tend to choose the deferred payment option in our data set, at least. And if that's the scenario you fall into, then it'll accumulate simple interest until repayment starts, and then all of that will get rolled in and then you'll start getting compound interest on the total. So it's simple interest until full repayments start, and then compound after. And that's actually part of a good reason why, if you can afford to, at the very least, make payments and really just pay off the interest, if not the principal, while the student is in school, it'll go a really long way, because when someone is in school for 4 years, the amount that they'll have to actually pay back, or you'll have to pay back when they graduate 6 months later, can be a little bit surprising to some people if they haven't been regularly checking and updating it. And so, a little bit to Debbie's earlier point, if it is a lot of people do choose to start making some payments earlier, and if you're able to, it can just help you in the long run.
So, and then Terry's asking a question. The options that you choose, are they defined after you graduate or now? And all these options that I mentioned, you need to define them at the beginning of the loan. So you actually need to, and that's part of the application process. You will tell the lender, do I want a fixed versus variable rate? When do I want to start repaying? How much am I willing to repay? And then how quickly am I willing to pay back the loan? You will tell them up front. And then that's the factors that go into the interest rate that they offer you. And I'm pretty sure, to tell you the truth, that once you set those parameters, most lenders don't let you change them on that loan.
Although in the vast majority of cases, you can start paying back earlier.
Earlier,
your
yes.
plan has required you to.
Yes.
If you run into a lender who is charging a prepayment penalty, that's usually a bad sign. So, because the vast majority, at least all lenders that we've come across, don't have prepayment penalties.
Yes, I should change. Yes, meaning if you want to prepay, you can prepay, but you can't. For example, if you picked a variable rate, you can't decide that you want to flip it to a fixed rate in the middle of after a few years. So Kim's asking, do you have to get a new loan each year? Yes. So this is kind of where the complication sometimes starts to build up. You end up with your student ends up with a lot of loans. So they have the federal loans, right, which is something that they borrow every year. And if they need more than that, they're going to have a private loan potentially with a cosigner every year. So at the end of 4 years, they're ending up with 8 loans, and kind of we'll meet you at the end of 4 years and talk about what you can do then, because you can consolidate those loans and refinance them, but you can't do that until after they graduate.
And maybe to answer Michelle's question, which is, do you have to use the same lender each year? No, you probably should be shopping around and making sure that whatever rate you're going to be getting for the second year, third year, fourth year is actually the best thing available to you. So,
right, exactly. Just to emphasize what Chris said, every year it's like you're, to some way, and this is a good thing, you were starting from scratch. You have no obligation to go with the same lender that you went with the year before. In fact, there might actually be a new lender, and Chris and I were talking about this before we started. There might even be a new lender in the marketplace that wasn't there the year before, who's giving a better rate than other lenders. So it's to your benefit every year to honestly to shop around. Okay, so let's see what time. I'm actually going to quickly go through this, but this is just to reiterate making sure that you get all the answers that you need to these types of questions. And this is part of the shopping process, right? You're shopping around to see what interest rates the lenders can offer you and to see what all of their options are. Some lenders are more flexible than others, and it's just, kind of the way that they've set up their business. But you should understand what the repayment options are. All lenders are offering a fixed versus variable rate, but the lenders differ in terms of like how the years in which they allow you to pay it back. Most lenders these days are giving some sort of a discount if you set up like an automatic deduction service to pay your monthly payment. So these are just all good questions that you should ask and get answers to before you're actually making a final decision. Okay, timing. As Chris, we already alluded to, and somebody actually, I saw a question. Somebody said that their school hasn't sent out the bill yet. That might be the case for a lot of schools. I would guess the majority have sent out bills. What is this? This is July 19th. But sometimes, but some haven't. If your school hasn't sent out the bill yet, You can actually still start applying for a loan, and we'll talk a little bit about that. And I encourage you to start. But if you do have the bill, you can finally figure out your exact amount that you're going to need to borrow. And, I would say that right now we're kind of in the 60 to honestly 30-day period where you should be starting the research process. You should be going out, looking at the different lenders. You should be getting pre-qualified rates, and you should be narrowing down which lenders you're going to apply to. And an important comment that maybe I don't think I made earlier, and I'm going to stress, is that when you start applying to lenders, like and actually putting in your final applications, the lenders will do a hard credit pull. And I think somebody asked, how many hard credit checks can you have? Because the credit bureaus want to encourage people to be able to shop for interest rates. So they know that when they see multiple hard credit pulls for the same type of loan, so in this case, when they see multiple credit pulls for a student loan, they know that you are shopping around, and they give you about 30 days. So from the first time that you apply to a lender, you have about 30 days to keep applying to multiple lenders, and your credit history won't be, you will get a little, hit to your credit history from the first hard credit pull, but that's about it. You won't keep getting hit on every time that there's a new credit pull in that 30 days. So they want to allow consumers to be able to shop around without having really deteriorating their credit score. So so you should apply to multiple lenders, because you won't know the final interest rate until you put in an actual application. And so that is this 60 to 30-day period now, where I highly encourage you to do the research, apply to several lenders. And then, Chris is going to tell you in a little bit about how Juno works. And so once you have offers from some lenders, that's how you'll be able to see which are good offers and which are not. Somebody also asked earlier, which lender is going to give me the best rate? We can kind of direct you to lenders where we see they're offering better rates, but ultimately you have to apply to multiple lenders to see which one is going to offer you the best rate. The same lender can give different people different rates because, obviously they have a different credit score, and they also are asking for a different type of loan. So all of those options that we talked about, fixed versus variable, when they're going to start to repay, how long are they going to pay back the loan, impacts the interest rate. So a lender might have offered me 5%, but they might offer you 7%. And the difference could be in what we're asking for, right? And so we can kind of, guide you to who might be lenders who we're seeing offer good rates, but ultimately you have to apply to multiple lenders to really feel confident that you're getting the best rates. Okay, Chris, you want to explain a little bit more about how Juno works and how it fits into everything that we've been talking about tonight?
Would love to. So again, thank you everybody for being here on a Tuesday evening. I hope you're getting a lot out of this presentation. I'm going to give you just a 30-second backstory on how I ended up here. And about 4 years ago, as I was going to grad school, I started trying to find the cheapest student loan rates in different places. And a few of my classmates and I started applying to every lender that exists. And then we had a public document for people to see what rates we were getting, so they could try to get some sense for where they should go to. That the next week turned into an experiment to see if we could bundle together a few hundred people who needed to get a loan at the same time and ask different lenders if they'd be willing to compete on the rates and terms that they'd offer to the group. And it actually worked. So for the last 4 years, we've been scaling that concept to many more schools. And the goal of it is people signed up on our website, telling us a little bit of information about themselves, roughly how much they'd like to borrow and when they'll need the money for. And then we spend most of the year running an auction between a lot of different credit unions, banks, and non-bank lenders by telling them on one side, this is roughly the dollar amount that we can bring to you. And on the other side, they give us a lot more insight into what rates and terms they might charge, and actually allow us in many cases to negotiate different rate tables, or in other words, a discount to the rates that someone would normally get if they went directly to that lender. And now what we've been able to turn that process into since about 2 weeks ago is we ran this process after we got 200,000 members. People who sign up on our site don't pay us anything. We can't even take your payment information. And because we got to 100,000 people who said, hey, we need to get a student loan for fall 2022, we were able to get one of the lenders that we worked very closely with to allow us to roll out a rate match process plus a bonus to anybody who comes through Juno using our links. So a few things I'd like to stress maybe as we go through would be one, I really would want you to, when you get a copy of this presentation, go back to the decision tree that Debbie laid out, because our goal in a lot of this presentation is to help you understand the scenarios in which you would make the trade-off between a Parent Plus loan and a private student loan. We wouldn't want you to use a private student loan if it wasn't actually the right product for you based on the things that we've walked through. If it is, then what I would stress is shop around. By all means, please do, and try to find any rate that you can that kind of meets your needs, because each person is likely going to get quite a bit of a different rate from one place to the next. And different people at the same lender will also get different rates depending on a combination of not just your FICO score, but in many cases also your income and your assets and your existing debt. So please do shop around. And at the end of your process of shopping around, I would ask you to check our website, joinjuno.com, and just check and see if the rates that our partner lender provides are better than what you found. And if they're not better than what you've already found, we have a really simple process where you can claim a rate match, and we'll just basically have you upload one document. We'll confirm that it's a real document, and then we'll change your rate with Earnest to the lower of the rates that you found. And we'll actually pay you a cash bonus on top as a reward for shopping around.
Here, I'm gonna skip to this page because it gives more detail.
do.
And there's no gimmick here, really. There's no gimmick. You know, this is all to help families find the best rates and really walk away with the best rate. And the way to do it is, you know, just as what Chris explained and what we've been explaining all night is to max out the federal loans and then make this decision about, am I going to go with a private parent loan or am I going to go to the private student loan market? And if I'm going to look for loans from a private lender, then you need to shop around, just like any other product in life, just like buying a car, just like getting a mortgage. You need to see what all the options out there are and then compare them. And then even after you do that shopping, because of the group buying power or the group negotiating power that Juno has been able to pull together, they are very likely going to match your loan plus give you potentially cash back, which will make it a better offer in the end. So here, Chris, you want me to, can you just go through these steps? So if people understand, there's no payment to Juno. It's just joining so that you can apply through their website to the lender.
Yeah, so maybe I'll just walk through the process on how this works. It's pretty simple to sign up on our website, and we don't take any payment information. We don't do a credit check on our site. We just ask you some very light questions, most of which are optional, to make sure that to actually show you the lender with whom we've negotiated a better program or deal that actually matches with you. And so we go through, shouldn't take any more than about 2 minutes. And then what you'll see is a page or anybody who has a child who's attending an undergraduate campus, you'll see a page that tells you about a deal that we've negotiated with a lender called Earnest. And under that program is how we've launched a rate match process. And so I'd say I really don't want anybody to use this unless we're actually providing the access to the best rates that are possible for you. And so please, by all means, shop around, check us out on our website. If you found something better, you're doing all of us a favor by letting us know, because A, we'll be able to match it, and B, we'll be able to honestly place a little bit more pressure on the entire industry to be more competitive and to provide better rates to everyone across the board.
So I'm curious, Chris, for the person earlier who said, and I can't remember the exact interest rate, like a 4.02% that they got at Invest in You. Should they come to Juno and see if they can get something better or get that matched?
Yeah, so say you got a 4.22% from Invest in You. If you apply with to Earnest using the Juno link, either you're going to get a lower rate than that for the same terms. If you don't get a lower rate, then what actually is going to happen is we'll have a simple process for you to match it, and then we'll pay you 3% of the loan value upfront to reward you for looking around and finding a better rate. We actually want to pay out these rewards. We want to train the market to actually shop around as much as you possibly can. And so I would say no matter how good your rate is, the worst case outcome is as long as you would qualify for Earnest, that we would match it plus pay you.
Right. So there's nothing to lose. No matter what the rate is you might have already gotten, there's nothing to lose to come to Juno, apply through your links to the lender, and either the lender will offer something better, or if not, you will get the same rate you came with, plus you'll get money back, up to the 3% of the loan. Okay, here's, so Christine's asking, how long does it take to get a loan through Juno?
Great question. So it's going to vary depending on kind of what documents you have ready and whether, like what type of employment you have, but it can be as little as, let's say, to get through the approval process, 2 days, to as long as maybe 3.5 to 4 weeks, with the vast majority of approvals coming in within 3 days. So if you start the process now, a majority of the time, you'll be able to get approved within 3 days of when you start.
So somebody's asking, I got 4.0 at Sally Mae today and went to Juno and applied with Earnest. So I should do the same thing that you just said if Earnest comes back higher.
Yes, absolutely. So in one of the emails that you'll get from us, or if you click on the link in the email that Debbie will send tomorrow, we just have a place for you to basically send us the equivalent of a screenshot. It's called an approval disclosure form from Sally Mae. If that says 4% fixed 5-year, whatever it actually is, then we'll get Earnest to match that same thing, same structure and same rate. And then you'll be able to get actually 3% of that loan amount back on day one.
Says, Susan's asking, what's the difference between undergraduate loan and parent loans on the Juno site?
Those are different places for people to sign up. And so I'd say just go to the top right to the sign up button. And as you answer the questions, you'll be slotted into or introduced to the right group, no matter, depending on what questions you answer. Parent loans, Debbie walked through about 20 minutes ago, are a bit different than just a student loan in that it's something that's only in the parent's name, whereas the student loans for undergraduate are almost always in the name of both the student and the parent.
And if you don't mind, probably came on a little late, but can you explain who Ernest is? Or
Yeah.
you're mentioning that name, kind of how that relates.
Yeah, absolutely. It's a great question. So maybe just to repeat it for 10 seconds, a lot of what Juno does is we try to get members who help us have negotiating leverage. And a member is just somebody who signs up on our site and tells us roughly how much they might want to borrow for school and when, with no obligation to do so. So we bid out our business as a group to different lenders each year. And Ernest was the lender who won our bid, basically won our business by providing this rate match program that we're now taking advantage of.
But, and just to be clear, because now that people are familiar with the name, they might see Ernest, and they might go to Ernest's site directly, but they have to apply through Juno, even though Ernest is providing the loan. You may not get the same rate if you apply on Ernest's site directly, as opposed to going through Juno.
Exactly. So you do have to use our link in order for us to be able to process that rate match and to process any of those rewards. You can kind of think of it as like we've spent a lot of time trying to create the equivalent of AAA or Costco, but for student loans. And so you just have to use the equivalent of that AAA link in order to get the discount.
Somebody's asking, does shop, because we've used the word shopping around a lot, mean pre-qualify, or is a loan application needed to get the loan details needed for the rate match process? So I'm guessing what they're saying, do they need to actually have just shopped around maybe through pre-qualification, or do they need to have actually applied to other lenders before getting a rate match?
So you will need to have applied and gotten an approval from another lender in order to do the rate match, which shouldn't be, so maybe the thing I'll just add to that would be use the pre-quals, use the soft credit pulls, the pre-qualification opportunities to get a sense for what rate that you might get from different places. And then when you find a structure of a loan, that's whether it's 5-year, 10-year, 15-year, fixed or variable, when you find a structure and a rate that seems really attractive, when you're shopping around, that's when I would recommend going further with that application. And taking the next step with that application is going to involve a hard credit check with that lender or almost any lender that you're looking at. And as long as in many cases, the rate that you see after a hard credit check is going to be really similar to what you saw for the soft credit check. So the way I would recommend shopping is to do as many pre-calls as you can, which won't impact your credit. Choose the handful of places that seem attractive, do the hard credit check there, and make sure that the loan that you'll qualify or get approved for is actually still a great rate. And then you use that number as what you do the rate match.
Patricia's asking, can a grandparent who's retired co-sign when they're applying on Juno for the loan?
Yes, but it is admittedly more complicated because the way that a lot of the lenders' underwriting criteria is set up is that it's partially based off of W-2 income, which I know doesn't make a ton of sense all the time. So the answer is, in short, yes, but it's a little bit more complicated, and we'd be happy to help you through that.
So the only thing I'll add, and I'm actually writing this answer now, somebody's saying, just kind of confirming, so they should shop and then apply through the loan for Juno. Yes, you should do that. But you should also just sign up for Juno now, and you'll just get their information. And signing up just honestly means creating an account. You're not applying for a loan yet, but you're just, participating in their site and kind of their group bargaining power. And then when you're ready to apply and see if the application through Juno can either get you a better rate, and if not, then it will match it. then you go through the application part of their Juno site, but you can still sign up now without being ready yet to apply. Okay, good question. Paul's asking if this is like the ultimate question. We get this, a lot. It's if we saved some money for college, is it better to spread that amount over 4 years and take out loans every year, or spread that money up front and take out loans in the last 2 or 3 years? Oops, wait, I didn't answer this other question. I can't say for sure what the right scenario is, because you actually have to lay it out over 4 years. There are some tax credits that you can get, depending on, different years. I would, and I can actually, Paul, if you want to send me an email, I have a spreadsheet I can send you if you want to play with, to kind of look at what the 4-year scenario would be. I actually sometimes recommend that families take out at least the federal loan every year, because again, it's that loan that's in the student's name, it's at a low rate. And if you figure out that you have enough money in later years, you can go back and pay off that federal loan at the beginning years. Again, but it's all under this, if you miss taking it out 1 year, you can't go back and get it. So that's why it's so important to look at 4 years, because I would hate that families spent all their money in the first 2 years, and then they got to the point in the 3rd and 4th year where they needed to, take out money in the private loans that might have been covered in a federal loan if they had taken the money out the first 2 years. So, if do that math, and you might get a better answer. But again, I encourage you to take out the federal loan, because you can't go back and take it out in later years, but you can always go back and pay it off if you realize that you have the extra money, in junior or senior year. Okay. Yes, I will include the link. How about this? I will include the link to the spreadsheet in the emails that we send out over the next day or two.
I see Robert's asking a question about, if the school bills you per semester, do you apply for loans each semester, or can you lock in rates for the full year? You do not have to apply one semester at a time. I would lock in rates now for the full year. And it's important to note that half of that money, if you're on a semester system, will be sent to the school in the fall. Half of it will be sent in the spring. And you won't start accruing any interest on the loan until the money is sent to the school. And so you will only be accruing interest on half of it in the fall, and then the full amount starting in the spring. If for whatever reason you decide you don't need the money in the spring, you can change your mind and cancel it.
Yeah, so I highly encourage, honestly, to apply as soon as possible. I don't have a crystal ball. I can't tell you exactly what's going to happen with interest rates. I will tell you the likelihood is that they will continue to rise, in the next few months, and they've already risen. And so we're trying to encourage people to lock in a rate now, lock in a rate for the entire amount that you need for the full year. As Chris said, if you end up not needing it in the second semester, then you just, tell the lender you don't need it, but at least you've locked in the rate, as opposed to, we don't know where rates are going to be in 6 months. And then if you applied again, you might end up with a higher rate because you waited.
Angela asked a question.
Yeah.
I'd be happy to take about, I think this is a broader question about private loans. What credit scores you probably need in order to qualify for a private student loan that would be lower than Parent Plus. And the way that I would think about it really is as follows. Almost all private student lenders have a minimum FICO cutoff at 650. And the higher, all the lower rates that you might get advertised, those are typically only going to be accessible by folks who are well into the 700 range. And so depending on where you are, Parent Plus can still be a good loan option. And so if you're unsure of whether we might be able to, or any private lender might be able to get you good enough rates, I'd say step one would be that pre-qualification process and seeing, hey, do I actually qualify, let's say, on Credible for any of the options here? And if so, are the rates I'm pre-qualifying for lower than, let's say, 8% on the fixed side, which is roughly the number we were talking about earlier that Parent Plus loan now costs. And if it isn't, and if that doesn't happen, that's when that Parent Plus option is still a good fallback.
So Penny's asking, if we get pre-qualified for a private student loan, do they run the soft credit check on the parent since the student doesn't have credit?
Often enough, both.
Yes.
So for a private student loan, both. For a private parent loan, that's only in your name, but no, the student wouldn't be running.
Okay, well, it's amazing how time kind of flies. We're almost at 10 to 10. But I really hope that for those of you who maybe didn't know enough about the federal loans and private student loans, that we've given you a good foundation of understanding what the different types of loans are, what the different options are that you should consider, that we have kind of lit a fire under you to go start shopping, go get your pre-qualifications, go gather this information. You are not too late, and and you're not early. So, I would honestly get going tonight, tomorrow. I want to emphasize, somebody was asking about, again, if you don't have your bill yet, you can still start the process. I would estimate what you need. I would overestimate, because it is much easier to reduce the size of your loan and much harder to increase the size of your loan. So overestimate what you might need. If you get your bill in 2 weeks and you need less, much easier to go back and tell the lender that you need to lower the amount. And so my point is, if you don't have your bill yet, that shouldn't stop you from starting this process. Okay, watch out for the emails over the next few days. They will be both the recordings of what we talked about tonight. It will be links to all the lenders we talked about. I will put in the link for the spreadsheet. And we're just honestly encouraging you to get started with this process. And then go check with Juno, and quite honestly, what they have offered, either way, you will win. Either you will get a better rate, or at a minimum, they will match your rate and you will get cash back, which will make it a better offer overall. So I hope it works out for everybody. Thanks so much, Chris. Thanks for participating. Thanks for your knowledge, and thanks for starting Juno to offer people an option.
Thank you.
Okay.
Have a great night, everyone.
Everyone, take care. Good night.